I'm Paul Johnson. I'm a chartered financial advisor here at the practice. I work alongside several other advisors. Those of you who are listening who are clients will be connected to one of these people. So all of us do this work with our clients. So it's part of the process, really. And that's what I want to try and explain to you today. Talk to you about some of the rules and understanding about pensions in general, but really focus on the retirement planning that we do with clients. And with all planning, it really starts with where are we trying to get to? Start with the end in mind. What is it that you want to do with the rest of your life when you finish work? And that is really the most important part of the planning that we do. Where do you want to get to when you finish? What do you want to do? You know, that this period of your life should be, I've finished working, so I've now got time, hopefully the financial resources, and hopefully the health to have some of the best years of your life. If you don't plan it out, it won't happen as well as you expect. Some people have got really clear plans. Some people have got vague plans, but really critically, spending some time thinking about what are the things we want to do and what are the most important things we do. And this should be a conversation between you and your family, you and your partner. For some people, they like to do this themselves and come back and share. So we will prompt them with questions and things to go away and think about and then come back and talk to us. It normally takes place over several meetings. For other people, they like to have, we're in the room and we facilitate the conversation. However that works, it's definitely important to involve your close friends and family. You don't want retirement planning to become divorce planning. There needs to be a common aim about where you're heading, because that's going to ensure you get the retirement you want. Once you've agreed on this lovely plan and when you're going to do it, then really start drilling down. What's out of all those things, what's the most important? What's going to happen in the first 5 years? And then even further, what's the most important thing? What are you going to do that very first year that you retire? What is the most exciting thing you want to look forward to when you finally finish work? And by doing that, it doesn't have to be a schedule of events, but just having a rough kind of idea, rough program of the things you want to do massively increases the likelihood of them happening. Then, once we've got and gone through the exciting human stage of it, done some, the financial planning aspects for you, then this is where we get to. So you've got you currently, you're a saver. You have a salary or you have income from a company every month that comes in. Suddenly you stop. At that point there, you're going to have a bit of a change of status. You're no longer an accountant or a mechanic or whatever it is you do. You're now retired. So now you're retired, and you've talked about and planned the activities and things you want to do. Then we can look at, what are these things going to cost? What is your cost of living now? What are the dreams, the aspirations you have for retirement? How much is all this going to cost? And then we can start bridging the gap between your life planning and the financial planning to make sure you've got the resources to achieve those goals. And there are certain levers we can pull. But for some people, I often have conversations saying, if that's what you need and that's what you want, why are you waiting? And for other people, you say, there is a bit of a gap and there are certain things we can do. It might mean saving more. It might mean spending less now. It might mean, moving back the retirement age by 1 or 2 years. Then there has to be a compromise somewhere between the lifestyle that you want and how soon you want it. There's going to be some competing elements there. And once we've got that down, then we're getting to the point where we've got a plan. So then we start looking at, what assets do you have? Have you got enough? How are we going to draw this income from the various things that you have to create the plan to provide the income, the goal for the goals that you want? That's really what the heart of financial planning is all about for me. This is one of it's really quite rewarding from our point of view to help people get to where they want, and then obviously we stay with them on that transition, and you guide them through, because tax rules change, pension will change, markets go up and down, your life will change. So that needs to be reflected in the plan. It needs to be dynamic. So one of the really useful tools that we use is called Cash Calc. It's a retirement planning forecasting software. We also use information from Financial Express to look at the past markets occurrences and volatility and all these things, and we end up with a really sophisticated plan. Now, just to be clear, no plan will work out as you expect, but the better the plan, the better the likely outcome. So what we aim to do here is build you a plan that's as accurate as we can using some assumptions. So let's start with that then. So this is an example of, I've just changed the name to Mr. and Mrs. A recent client. I've just, someone I was working with recently. We have to put some assumptions in. And the assumption in this forecast is that inflation is going to be 3% for the rest of their lives. Now, you could argue at the moment that might seem ambitious, but over the last 20 years, it's been around 2.5%. The government's target is 2%. So you could say, actually, this is 50% higher than the government's target for the rest of your life. Later on, and I can show you how we can stress test that to see the impact of higher inflation, which is, is quite significant on longer term, on sustainability of your assets. So we've made some assumptions and we've agreed them. Then we have to put some potential growth assumptions. I've used 6% in this example. Some people who are very cautious and higher amount of fixed interest, for example, in their asset portfolio, we might lower that. And then obviously we've got some cash, 3%, just matches inflation, which may or may not happen again, of course, but we just enter these assumptions at the start. So then we look at what incomes. This client's got a defined benefit scheme. They used to be called final salary schemes from IBM. They've got their 2 state pensions and they've got a buy-to-let. So we put these various sources in. Then we start looking at, okay, at the moment, if your plan is to work up to state pension age for the husband in this scenario, then you're going to have these are all the different income streams. We've got the IBM pension, the husband's state pension, buy-to-let income. Then in 2 years' time, his wife's state pension starts, and then I've just taken 4% a year. Now that's considered to be a safe withdrawal rate. The idea then, if you're £100,000, you took 4% every year, which is £4,000. Provided the growth was in excess of 4%, the capital value should more or less stay the same. As I said, my assumption in this forecast is that if we make 6% a year, so actually we've allowed for inflation, so the monetary value, the amount it says in your pension, will increase, but actually in terms of what it's worth in terms of buying power, inflation should more or less stay the same. So under that scenario, when we built the forecast, we looked at their expenses and they said £3,000 a month. They've paid their mortgage off, so £3,000 a month of net income, take-home income, is sufficient. And they think that a couple of holidays a year that they want to go across the Atlantic. There's plans they had in Europe. They think that their dreams and aspirations are going to cost about £8,000 a year. So we put those two together, and then we have an expenses line, which is this line in black here. So they need £44,000 of net income a year. Whether they continue to spend that to age 100 is another matter, but for now, this is the assumption that we start with. And as you can immediately see, they're going to have more income than they need, and actually they'll have quite a substantial amount of money left at age 100. So quite often, as I mentioned at the start, these conversations then switch on to, why are you waiting until you're 66 before you retire? What about if we looked at 60? And obviously that comes down to if someone's ready to leave and have they had enough of work. And actually for new clients, that's quite often the time we get to speak to people. They go through their life, they work for different companies, they build pension pots. Sometimes there's several left behind. Then they get to the stage where they've kind of had enough of working, but then they think, I probably should speak to a financial advisor because they want to know if they've got enough. Is that realistic? So in this scenario, we said, well, what about if we looked at age 60? You've got your buy-to-let income, your defined benefit, the IBM pension here. If you take this early, there's you lose around 5% a year for doing that. So there is a reduction in the income from that, but you get it for 5 years early, and it will index link for 5 years. So it's not quite as severe as it might seem. We've still got the 2 state pensions coming later on. And then we can be a bit more strategic and say, well, if we start drawing from the ISA and from the 2 pensions, because this is the pension pots, this is the available assets that they have. They've got some savings and some premium bonds. They've had a mixture of stocks and shares, ISAs, and they both have various pension pots, but I've just put as a combined value. So once we've here, we can see actually, if £41,000, so £44,000 a year of net income is what you want, that's completely achievable. And there's still going to be money left at age 100, which means there's either scope for gifting to their children, or there's scope for things going wrong, things which I'll explain to you a little bit more in a moment, because we never know what the future is going to hold. So we want a certain amount of leeway, depending how the future runs out. So once we've done this, which is, you can imagine for these clients, this is a big change to their view. She was particularly really keen for her husband to stop working, quite a stressful role, long hours. To have an extra 7 years of time together and time to enjoy is significant. Then the next thing is, once we've done they've built the plan for them, as their life plan, then we've looked at an income plan. Then is what can we tweak here to make this more efficient? What can we do? Is there some technical advice elements that we can do to build into this plan to make it more efficient? And this is part of it here. So again, we've got the buy-to-let income and we've got the defined benefit income. Now, the buy-to-let in this couple's example is in the husband's name. So this means, so it's 50-50. Yeah, it's 50-50 owned jointly. So the husband's income before state pension age, he's using his personal allowance. That's the first £12,570 of income that you earn is tax-free. So with half of the buy-to-let income and the IBM income, he's basically using that allowance. But his wife's only using half of that figure each year. So she's got some of her personal allowance left, which means we can extract money from the pension completely tax-free. Pensions are 75% taxable, 25% tax-free. So if you took £10,000 out from your pension, 2,500 would be tax-free, 7,500 is potentially taxable. But if it sits within your personal allowance, that free £12,570 first band of income is taxed at 0%. So it's really efficient to take this money from a pension now. And then we say, okay, what other pools do we want to pull upon? Now, the stocks and shares ISA would always be the first thing you pull upon ahead of the combined pensions, because pensions are written under a trust and they're outside of your estate for inheritance tax purposes. So a mistake we often see people do is they start spending their pensions because they link pensions in retirement naturally and don't realize actually these are the assets that could potentially be subject to 40% inheritance tax if as a couple with children, they have £1 million worth of allowances. So there's another efficiency there. So more efficient way of drawing the pension to start with, but maxing out using the ISA as the next port of call. Then once the state pension starts, actually what income they need is reduced because you've got these two 10,600s coming in. So we just need a little bit less from the ISA until we fully deplete. So you can see that more clearly on this graph here. So this is the same asset values over time. So we've got the combined ISAs, and you can see we're slowly diminishing that until there's nothing left. This at the bottom is cash. How much cash you leave is really quite a personal thing. This is about 2 years' income. My view is, I think having 1 year's income in cash is a kind of safe and secure, secure enough. But for different people and their different attitudes, then having 2 years, you would say, is more secure. And if that's what they're comfortable with, then that's the right figure. Now, the other thing to think is what, this plan here, just a point to say is inflation is factored in. So in monetary terms, the expenditure expected to go up by inflation, which I've put in as 3% every year. So you'd expect you need more money every year. You'd expect the IBM pension is index linked, so that should increase. It may be capped to a certain extent, but it will increase as inflation goes up. The two state pensions are index linked, and over time, it's fair to say you can increase rental yields in line with inflation. It would be a fair thing to do as a landlord. Now, I guess one of the key points here is that's all well and good, but markets don't always perform as well as we would like. So one of the things we look at is kind of adding some possible scenarios in. So let's have a look. What happens if we said for the husband's pension that we want to make sure his £348,000 pension never goes below £300,000 for the rest of his life? How likely is that to happen? How probable is that to happen, you could say? So this runs 10,000 possible scenarios based on the Financial Express data that they have about previous markets. And you can see all these grey lines just and extrapolate all the past market variances and run 10,000 different scenarios. And under that, there's an 84% chance of them staying above 300, of that particular pension staying above £300,000 for the rest of his life. So again, this provides a lot of confidence for people to say, okay, so even if things under a vast number of scenarios, I'm going to be absolutely fine. I'm still, £300,000 in the pension at 100 is a nice legacy to leave. And then you can also look at things like, what happens if, if you really push this out, we've got different scenarios here, but what about if there's a 2008 credit crisis, when they were 65, the market's really bombed out, 30% full, and that's going to affect all invested wealth. So that's the pensions and the ISAs. So we can run a simulation and just put in, that's a 35% market full. We can apply those and we can say, okay, what's that going to do to the outcome? And where you see here, it's taken around about £800,000 away of the money they'd be expected to have at age 100. And you can see in the asset values here, things are going nicely, the world goes upside down, and then things obviously start to recover again. Now, that is going to happen. There are things that are going to go wrong in people's plans, but we need to make sure that we've looked at it and say, have you got the assets and the security to be able to afford things going wrong? And in this example, yes. The growth forecast that we've used at 6%, that is the average over time. There will always be variances in what actually happens, but over a 5, 10, 20-year period, the longer the period, the more likely this average will be borne out in reality. So that, in terms of the planning stages, is really quite a quick summary, really, of the work that we do and engage with clients. You can see here, this is the money they're expected to have at 100. If I put inflation up, say, to around 4%, you can see the higher the inflation is for the rest of their lives, this money at age 100 reduces. So that's something to be aware of. We don't know what high inflation, the future of inflation is going to be, but it's to be mindful of the fact higher inflation for longer will have a negative impact on the sustainability of your income. And then once this is in place, our job as financial advisors is each year we come along, have an annual review. Obviously, we're available for advice at any time, but have a formal review every year. How are we doing towards our plan? How is your expenditure what you thought it was? Is it more or is it less? And then just keep adapting the plan each year just to make sure we're on track to deliver what we're hoping to. So now I've kind of explained how pensions are used and the retirement planning things. There's just a few things I just wanted to talk about. So if you've got to a stage where there's a shortfall, or you're getting nearer to retirement and you're wanting to retire sooner, whenever there's a gap, one of the most efficient ways to fill the gap is through pension contributions. Now, one of the reasons they're so efficient is because you get tax relief. So for a basic rate taxpayer, if you put £80 in, the government will give you £20 to make the total contribution 100. For higher rate taxpayers, it's 40% tax relief. So you put 60 in to get an effective £100 into your pension. And for additional rate taxpayers, 55 to 45. So that's a significant swing at the start. Now, the next thing is once it's within the pension, it's not subject to capital gains tax on the growth. It's not subject to income tax on any dividends or any interest just sent from the funds. So if you compare to a buy-to-let increases in value, capital gains tax on sale, you get an income from it, a rental income is subject to income tax, not so with pensions. And one of the key things, as I mentioned earlier, is they're free of inheritance tax as well. So there's lots of tax relief going in, tax relief in the funds, and tax relief when you pass them down. The rules are really quite flexible about how you draw money. Some people, an annuity is a good idea because it gives you a fixed and solid and guaranteed income for life. It's subject to your health and your age, but that has suddenly become an option that wasn't previously. That's because interest rates are high at the moment. And as part of the process, we quite often would go through and get the quotes and just to see if this is something that's going to work for you. The other option is drawdown, and you can stop, start, increase or decrease the withdrawals according to your needs. So as I showed you with the plan for this couple, when their state pension starts, they need less. There'll be times in their life where they might have a big holiday or a family wedding they want to support and take out a lump sum. Pensions provide that flexibility. The other thing is, if you pass away, your pensions can go to your spouse free of inheritance tax. And if they don't spend the money, it can go to their children free of inheritance tax. So if you keep it within the pension trust arrangement, it's got some massive, basically some real good benefits to being a legacy trust that can pass down through successive generations. There's some different rules about whether you die before or after 75. Essentially, if it's before 75, you can take the whole lot as a tax-free lump sum, or you can take it as a dependent's pension, which is completely tax-free when you take the income. After 75, you inherit it as a pension. So it's 75% taxable, 25% tax-free cash. In either way, there's no inheritance tax, and either way, it's a really good way of passing wealth through down through generations. So what are the limits on what you can put into your pension? Is the first one really is the annual allowance. That's increased this year to 60,000 gross. So that means 60,000 including the tax relief that you'd get, and that includes employer and employee contributions. Previous years were 40,000 a year. If you haven't used previous year's allowance and you are lucky enough to have sufficient cash available or surplus income available, you can capture your last 3 years' allowances through something called carry forward. That's a calculation that we can help you with, but so it's not lost over the last few years. There's a chance to recoup it. If you're fortunate enough to earn a very high income, or you've worked hard enough to get into a situation where you have, your annual allowance of £60,000 is tapered down to 10,000. Now, the other limit to pensions is what you earn. So if I earn £30,000 a year, that's the most I can pay into a pension. It's called your net relevant earnings. So the two caps are either whichever the lower of your annual allowance or your earnings for the year. Now, the next one is something called the lifetime allowance, but actually, in the budgets in last March, this has been completely removed by the Conservative government. This is significant for people who not just have around, as you can see, £1.073 million in their pension, but also for people who are maybe 50 years old and have £500,000 in your pension, because this is tested. It was going to be tested against a lifetime allowance at age 75. So growth between 50 and 75, 25 years, there's a chance that lots of people would have fallen foul of this. This has been completely removed. And now we can't make any promises about what Labour or any other government that come in would do. But my point back here is, it is rare that governments apply laws and taxation retrospectively. So if you have made pension contributions under the pension rules, they then reinstate the lifetime allowance. Then when pension freedoms at A-Day, when they changed all the pension rules a few years ago, they gave people transitional protection to say, actually, you had higher tax-free cash, or you were over the lifetime allowance. We will earmark that to one side and say, okay, we're not going to hit you with a charge. It's for all future people. So I think we can only ever plan what the rules are at the moment, and the rules are there's no limits to what you can pay into a pension. I mentioned state pensions in the forecast. So a lot of people overlook these. Now, the first thing as part of the planning process we do is you fill out a state pension forecast. There used to be the form BR19, but you can just go onto the government gateway account and do a pension forecast, and it will tell you need to have done 35 years of qualifying years in your life. Now, that could be time where you're looking after children. It could just be time where you're earning. But it's always worth doing a forecast. I urge you, for anyone who hasn't done that, to do that now, because you can buy back missing years. And I would say they seem to be about £800 a year, but you're essentially buying additional guaranteed index-linked government-backed income. Well, it's guaranteed for as long as the state pension's in place, and people may have opinions about that. My view is what they're doing is increasing the state pension age over time, and that in itself is reducing the number of people that will benefit from it and the length of time people will have the income. So that state pension is taxable, but it's a really important part of your retirement plan. As you saw the example, that's about £21,000 as a couple of solid income, to work towards and then build into the plan. And you add in your own pension, and then we start to get to it. So one of the things as well, just to be aware really of compound growth. We've shared this previously, and I just like the impact of this. So the minute my children were born, I've been paying into a pension for both of them. Now, £5 a day works out to be £1,825 a year, as you can see on the slide, plus the 20% tax relief of £456. If you continually do that for 10 years, they end up with £35,000 in their pension. But what you find is, after the first year, the growth you get on the first year, so if you had £100,000 in a pension and you had 10% growth, and you had £110,000 at the end of the year one. And I'm just picking numbers because they're easy for my maths. I'm not in any way expecting to get a consistent 10%. But for the second year, if we got 10% again, then it's not of the original 100, it's now the 110. So actually, what you get is a compounding effect over time. So in this example here, where they had 35,000 in the first year, and they paid in there for 10 years, and then they stopped paying into their pension and never did anything again, you would expect, using a growth forecast of 7.2%, that the money will double every 10 years. So actually, that money spent in the first 10 years, when they get to 65, is in excess of £1 million. So that really is a visual example of the power of compound growth. Now, for other people who've got less time, people say, I'm 58, so I'm planning on retiring, but I'm 62. Is it too late to pay into a pension? 5 years of compound growth is worth having. And actually, when you get in this example, this fortunate child whose parents have been very kind to save them £1 million, when they get to 65, they're not going to spend that whole million, or you hope they're not going to spend that whole £1 million in their first year. So they're going to be invested for the rest of their life. And actually, if they don't spend it, they can pass it down to their children. Like I mentioned earlier, tax efficiency. So yeah, that's a really good example there. So that's really covered the main parts of it. Now, I guess the takeaway from today is, if you haven't got a plan, whether you're 40 or you're 60, that's the start. And we start with the human side, then we build in the financial side, and then we make it really bespoke with the cash flow forecasting software. So that's the key thing to start off with, trying to get to the stage where you have a figure, and that's based on the plans that you want to have and you want to do and you want to enjoy in your retirement. If you want any help with that, please get in touch with me or with the practice or any other advisors here. We can all help you through this. The key part of what we really do is to make a complicated area simple. And that's one of the key things we do at New Forest Wealth Management. So there was a couple of questions posed, but I think I've managed to answer them during the call. They were posed before the event. As this isn't live, if you have any questions, you would like to discuss this in any way, please get in contact with us. We'll be more than happy to help. Many thanks.